Goldman Sachs warned about it last week, Brian. They said everything's just kind of getting too concentrated like it was before. You're not that worried. Why not?
We're not. Good morning, by the way. As you adeptly said, Brian, these stocks led on the way up. They led during COVID, and looks like they're leading out of COVID as well. And there's a reason for that. The reason for that is, from a secular perspective, these stocks are exquisitely positioned. We've seen this before in the past, and we actually wrote a note about this on Friday. We saw it in 2000. We saw it in 2008. We saw it in 2012. The difference, especially since 2000, many people want to go back to 2000 because of the quote-unquote tech wreck. And two of the five in 2000 were Microsoft and Cisco. The problem was that was an overcapacity-led recession in 2000, where this has been a recession, and a great recession, by the way, potentially, that was really more about natural disaster in our view. And so as the market continues to build more confidence, and investors have confidence, quite frankly, in these names, Brian, and building confidence in the overall market, we believe the biggest test for these companies, quite frankly, and their leadership will come when and if the market begins to broaden out. We think the best chance, quite frankly, from a common sense perspective, Brian, is for the market to begin to broaden out once investors, quite frankly, can get a better feel for first and second quarter earnings. And that's not going to be until later this summer.
No, it's not. And you wonder, where's it going to broaden out to? Okay, you can look at oil and energy stocks. They're down big because oil's at $20 and change. You can look at real estate. That industry is hurt because commercial rents, they are likely to come down significantly in some areas. But what about other areas of the market, Brian, particularly the banks, like the one that you work for? That seems to be the most troubling sign and sector performance to many people.
Yeah, it really is, Brian, because I think people like to look at historical parallels. So obviously people go back to 10 years ago in the financial crisis. And from our lens, when you take a look at banks, they are way better capitalized. Oh, by the way, from a management perspective, way better managed. And so if you take a look at how the banks have reported, when they reported earnings, they had huge loan loss revisions. Same thing's going to happen in Canada here in the next couple of weeks. And so what we have found is that once banks report these huge loan loss revisions going out 12 months, they do very well from an historical perspective. But bear in mind that financials in particular, I think, will help define this rotation, Brian. We saw a little bit of it 2 weeks ago, if you remember. We in the marketplace started talking about this move into value. I thought it was a little bit too early, but value in particular, I think, is going to be a huge strategy once we start to have earnings begin to really broaden out throughout the rest of the market. So it's things like your life and blood, energy. I know you love the energy sector. Energy actually could see a bid, but I think it's really going to be financials. And we talk about it in our report on Friday. Another one of these sectors that are approaching all-time lows in terms of sector weight within the S&P 500. Typically and historically, that's another very strong buy signal. So it's the big banks, Brian. Morgan Stanley, Goldman Sachs, Bank of America, JP Morgan. These are names that actually have real book values, Brian, and real earnings and dividends.